Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of why the Modigliani-Miller Theorem matters in modern finance. Understanding the Modigliani-Miller Theorem, key insights and implications. The Modigliani-Miller Theorem reshaped how we think about finance and capital structure. At its core, this theorem argues that a company's value isn't affected by how it finances itself, whether through debt or equity. This idea challenges traditional views and invites us to reconsider the criteria we use to evaluate financial decisions. In this video, we'll break down the theorem's key insights and explore its real-world implications. Understanding this concept is essential for investors and finance professionals alike. By the end, you'll see why this theorem remains a cornerstone in financial theory, affecting everything from corporate strategy to investment analysis. Ready to dive in? Let's explore how this fundamental principle shapes our understanding of financial stability. Overview of the Modigliani-Miller Theorem. The Modigliani-Miller Theorem is a key concept in finance that shifts our understanding of capital structure. This theorem suggests that a company's value remains constant, irrespective of how it is financed, either through debt or equity. This idea has had a profound influence on financial theory, challenging long-held beliefs about capital costs and investment decisions. Historical background. The origins of the Modigliani-Miller Theorem date back to the 1950s. Franco Modigliani and Merton Miller, two influential economists, developed this theory during their work at the University of Chicago. Their groundbreaking paper, published in 1958, set out to answer a critical question: does the way a company finances itself affect its overall value? Modigliani and Miller's research came at a time of rapid growth in corporate finance. Their findings were revolutionary, suggesting that under certain conditions, the capital structure is irrelevant to firm value. The theorem is often cited in discussions about efficient markets and has influenced countless academic studies and real-world applications. Core propositions. The Modigliani-Miller Theorem is built on several core propositions that have far-reaching implications for finance. Irrelevance proposition. In a perfect market, the method of financing does not affect a firm's total value. Whether a company uses debt or equity, its worth remains the same. Optimal capital structure. The theorem argues that there is no unique optimal capital structure. Instead, firms can choose a mix of debt and equity that best suits their business needs. Cost of capital. The overall cost of capital remains constant regardless of the capital structure. As a company increases its use of debt, it pays less for equity, but the total weighted average cost of capital stays unchanged. Market assumptions. This theorem relies on several assumptions, including perfect information, no taxes, and no transaction costs. These conditions are rarely met in real life, but they serve as a theoretical foundation. Tax considerations. In a more relaxed version of the theorem, Modigliani and Miller acknowledged that taxes could influence capital structure decisions. Here, interest on debt is tax-deductible, which can create a preference for debt financing. These propositions challenge conventional thinking in finance. They offer a framework to analyze how different factors can influence a company's financial decisions, emphasizing the importance of understanding market mechanisms and behaviors. So, what does this mean for investors? It highlights the need to look beyond simple ratios and metrics when evaluating a company's financial health. Assumptions of the theorem. The Modigliani-Miller Theorem relies on several key assumptions that help define its framework. These assumptions create a simplified view of the financial world, which may not reflect reality, but they are essential for understanding the theorem's implications. Perfect capital markets. Perfect capital markets are theoretical scenarios where all participants have access to the same information. In these markets, there are no transaction costs, no taxes, and no regulatory barriers. Here's what this means for investors and firms. No information asymmetry. Everyone has equal access to information about investment opportunities. No transaction costs. Buying and selling securities occurs without fees, making market entry and exit smooth. Unlimited borrowing. Firms can borrow as much as they need at a fixed interest rate, which simplifies financing decisions. In perfect capital markets, securities can be traded freely, and prices reflect all available information. This assumption allows the theorem to claim that financing decisions do not affect a company's overall value. No taxes. The assumption of no taxes plays a significant role in the Modigliani-Miller theorem. In the absence of taxes, the financing mix of debt and equity doesn't alter how much a firm is worth. Why is this important? Here are a few points. Neutrality. Without taxes, firms have no incentive to prefer one form of financing over another. Debt and equity become interchangeable from a valuation perspective. Cost of capital. The total cost of capital remains unchanged, making the analysis straightforward. Companies don't benefit from tax shields associated with debt since there are none. Simplified decision-making. Firms can focus on operational efficiency rather than navigating complex tax implications when choosing how to finance their growth. By setting aside taxes, the theorem challenges traditional views on how different financing options might impact a firm's financial strategy. No bankruptcy costs. Ignoring bankruptcy costs is another key assumption underlying the Modigliani-Miller theorem. In reality, bankruptcy can lead to significant expenses and operational disruptions. Here's how it affects the theorem. Risk assessment. Without considering bankruptcy costs, firms perceive debt as risk-free. They don't factor in the potential downside of excessive leverage. Simplified valuation. If bankruptcy costs are excluded, the analysis of capital structure becomes straightforward. Firms can't lose value from default if there are no associated costs. Encouragement of debt financing. The assumption suggests that firms can stack on debt without worrying about the consequences. This could lead to over-leveraging in a real-world scenario. While this assumption simplifies theoretical discussions, it's crucial to recognize that many companies do face real bankruptcy costs. These factors can ultimately shape their long-term financial strategies. These assumptions set the stage for the Modigliani-Miller theorem, challenging conventional wisdom in finance. While these ideas may seem idealistic, they provide a useful starting point for understanding capital structure decisions in the world of finance. Implications of the theorem. The Modigliani-Miller theorem has significant implications for how we perceive capital structure, financing decisions, and their overall impact on firm value. Understanding these implications helps investors and stakeholders make informed decisions about corporate strategies and investments. Capital structure relevance. One of the most striking implications of the theorem is its assertion that a firm's capital structure, how it balances debt and equity, does not influence its overall value. In an ideal world described by the theorem, whether a company uses more debt or equity, its market value remains unchanged. Why does this matter? Here are some key points. Focus on operations. Companies can concentrate on their core operations rather than getting caught up in financing strategies that won't affect their value. Flexibility in financing. Since capital structure is irrelevant, firms have the freedom to choose the best financing option without worrying about market impact. Market efficiency. The theorem assumes markets are efficient, meaning that all relevant information is already reflected in a company's stock price. Therefore, no financial engineering or restructuring will yield a different valuation. Imagine a pizza shop deciding between buying more dough, equity, or taking out a loan for ingredients, debt. According to this theorem, it wouldn't matter to the shop's overall worth which option it chooses. What's crucial is the quality of the pizza itself. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.